Hello traders, Gary Wagner here, just about 12 o'clock in Honolulu, 6 o'clock in New York. It is Friday. Happy Aloha Friday. It is Friday the 13th though, 2017, and this is the Daily Report for Gold and Silver, our weekend review. And what a way to end the week. Gold up, large spike up $9.60, blazing above $1,300 an ounce to close at $1306.10. And realize that's a 2% gain of value on the week. Silver did very well, up about 17 cents at $17.44, and that is all in light of a dollar that was fractionally unchanged on the day at 92.93. We did, of course, put on a trade on Monday. We'll talk about that in detail, and this morning we sent out a special trade alert to recommend that our clients trail those stops up. We'll talk about the specifics as we look at this, our first technical study. Well, traders, today we got the answer to the current inflationary numbers. They came out much meeker than expected, and as such are raising questions as to whether or not the Federal Reserve will raise interest rates in December of this year. Today's move resulted in gold closing at $1306.10. That is a move of approximately $9.60 and a dynamic move to say the least. Key to us is the fact that we had gold prices trade and close well above $1,300 per ounce on the day, and traders, that is significant. We have now seen gold trade from about $1,265 on this current rally, now closing at $1306. If you recall, on Monday of this week, we sent out a special trade alert recommending that subscribers go long, and that would have been this candle right in here. And that would have been the initial entry price. And our initial stop, of course, was placed just below these lows. So we recommended placing stops below $1,260. Of course, throughout the week, we had the market trading higher, but nominally over the last couple of days, as you can see with these small-bodied candles here. But today, we had a dynamic price surge above that particular level of former resistance. So what we did is we sent out a special trade recommendation this morning telling our clients to go ahead and raise your stop from below $1260 and to place it below $1290. And the rationale behind where we have moved our stop is, first of all, as we talked about yesterday, we wanted to see today's action and whether or not those inflation numbers would move the needle, so to speak, and take gold prices above 13. We obviously got that. So by placing it at $1290, we are placing it below the low of today's candle, a couple of dollars below that, and as long as 1300 holds as an active support level, even if it dips in 1295, 1296 in that area, our stop will hold and it will allow us to watch this price move to the upside. Now, maintain your current long position, which is at 1287. Maintain your current stop, which is at or just below 1290. The next levels that we are going to be looking at in terms of resistance in the market, we've got a very, very minor level of resistance that comes in roughly at 1310. That is the 50% retracement, and that's a smaller retracement of really the second leg. The most important numbers are really these numbers on the far left because they are a fib retracement from this long and dynamic move up the entire length of the last rally. Of course, the subsequent decline comes in just at about the 61% retracement area. Let's go ahead and straighten that line out right here. And as you can see, that comes in at 1265, and our low here was 1262. So we do have 1303. We obviously have taken that one out and taken it out in a strong manner. And so our next real target and level of resistance that I believe is still minor comes in at around 1322. That is the 23% retracement of the entire rally. And then, of course, I believe our major level of resistance, should the market continue to track higher, my belief is that we will find some real resistance in the market if and when, and I believe it's more a when than an if, but we challenge the all-time or the current record high of 2017, which sits at 1360. And I believe we will not only challenge this particular price point, but I believe we will take it out. Because realize, traders, that just above that particular price point is the record high since we had this market come down from the record top at 1900, falling to these lows of 1040. That would be this area right here that comes in roughly at 1380. So that's the mark we absolutely want to take out. And what that would do if we take that out is then we can truly say we have seen a series of higher highs and higher lows on a long-term basis. And traders, what I mean by that is as follows. I've compressed our daily into a weekly chart so we can look at more time. As the market moved from 1900 down to these lows over a multi-year extended correction, the lows that it hit were 1040, and that was at the end of 2015, beginning of 2016. Then we had this sizable spike that took us to a new high, which was roughly just at around 1380. As the market came down, we had this low that came in just at around 1120. So we had a low that came in. We then had our high that came in. We now have a higher low on a long-term basis. And for us to continue to operate within the confines of a bullish model, we need to see the market go to a higher high. Traders, we were able to really see this market spike up tremendously today and actually all throughout the week. Of course, we're long at 1287. The market is now above 1306, and our stops are above our entry point, which means that regardless of what happens, we will walk away from this trade either unscathed or with a decent profit. And it is a decent profit that I think we'll see. This has been Gary Wagner, wishing you as always good trading. We will talk to you on Monday for another daily update and review. Bye-bye.